Welcome to WMRE's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at WMRE. Let's jump right into this week's podcast.
Hello and welcome to the Common Area with your host, David Bodamer. David, how are you?
I'm doing well. It's still a little chilly in New York City. We had like one day of warm weather just to pretend, and now it's cold again. So,
just a little bit of a tease, I'm sure.
Yeah. How about your part of the world?
Oh, it's the same, man. It's a frozen tundra. I woke up this morning and I asked Alexa, what's the temperature outside? -1. Okay, just stop talking now. I don't want to listen to her anymore. I know that you've got a guest on the show again today, and I hope it's warmer where Ian is. Who'd you bring on the show?
So yes, with us today, Ian Formigle, who is the Chief Investment Officer with CrowdStreet. So hi, Ian. Welcome to the show.
Thanks, David. It's a pleasure to be on today.
So the reason I brought you on was you guys put out this interesting report that looks at some of the best places to invest in 2022. But before we dive into that, I just wanted to give you a moment to talk about, talk about yourself and tell our audience a little bit about CrowdStreet for those who may not have heard of the firm.
Absolutely. Be happy to. So my name is Ian Formigle. I'm the CIO of CrowdStreet. CrowdStreet operates the nation's largest online marketplace for commercial real estate investing. It's a two-sided marketplace where commercial real estate operators and developers will come onto it. They'll present private equity offerings that are subscribed to by accredited investors all over the country. I serve as the key decision maker for all the deal flow that goes onto the marketplace. We launched in April of 2014. Our company dates back to around 2012. I joined as a CIO around September of 2014, essentially after the first two deals had gone live. Since inception, we've funded over $2.8 billion in equity across about $22 billion worth of properties. That spans 44 states, I guess if you include DC. And we just came off a record year of funding about $1.2 billion in 2021 alone. So that's a little bit about us.
So that's interesting too, that you're coming off such a strong year, and especially to hear, because you're working, like you said, largely with retail accredited investors, correct? So we're talking about people that are looking to, who have a little bit of money to invest, and they're trying to get some exposure to real estate, and they're looking to a platform like yours to get exposure. So that speaks to some pretty strong demand overall for the space from that kind of investor. Is that fair?
Yeah, that is correct. Every investor on the marketplace does meet the SEC definition of an accredited investor. So they either meet the income test or the net worth test. And in essence, what the investors are looking for is the opportunity to diversify into, direct commercial real estate private equity offerings. So they join, they start learning, they begin investing. About 70% of all of the investors on the marketplace are repeat investors. Mm-hmm. The average repeat investor has now gone into roughly 6 investments. The typical ticket size or individual investment increment is just under $50,000. So they're here to basically build diversified real estate portfolios in direct CRE deals all over the country.
Yeah, I think I just find that such a interesting evolution of the marketplace, because it seemed like for a long time, unless you had a direct in to somebody at a real estate company who you make a placement with, you were maybe more limited to doing just stuff with equities. But now, as an accredited investor through the platforms like yours, it gives folks this opportunity to make these direct investments in commercial real estate. So I find it's an interesting and dynamic part of the market. So I'm sure you must feel that way, having been operating there with it yourself now for like you said, for the last 7 years, right?
Yeah. And what's interesting about that was that, the platform of CrowdStreet was really born out of the Jobs Act of 2012. And mm-hmm. So the co-founder of the company, Darren Powderly, he was first out of the gates with this, and he saw this opportunity back in late 2012 to say, hey, look, when the Jobs Act, and particularly Title II of the Jobs Act, would go live, and that occurred in September of 2013, it was going to enable, for the first time since the passage of the Securities Act in 1933, the opportunity to publicly advertise, a Reg D private offering. So the way that in parlance, the way I always like to describe it as, you could think about these, these Reg D private offerings, and it was always relationship first, get to know an investor, get to know their criteria, their suitability, and so forth. And then you could show them deal. And so that translated into what we call the country club type deals that were getting done at, friends, local, and all that kind of stuff. But it was really fragmented, and it was very much local. So what the Jobs Act did was it turned that around. It could essentially give you the opportunity to put the deal first and then the relationship second. Now, provided that every investor in that deal was an accredited investor. And so what we saw as an opportunity, and what Darren and then Torstein, the two co-founders, saw as opportunity, was if you could operate in that now 506C environment, you could now go advertise deals, which meant you could put them online. And if you could put them online, you could take them anywhere. And now you could really open up the country and eventually probably the world to investors can be anywhere, meeting sponsors online and finding their way to deal flow. And what we saw, and as an individual investor, and what we've seen over the last 7+ years, is the access for the individual is the main thing, right? These are investors who are saying, "Hey, look, I live in Seattle, but I would love to invest in Florida. I hear great things about the momentum that's coming to the Florida markets and growth there," or vice versa. You got somebody who lives in Orlando that says, "I'd love to have an opportunity to invest in a multifamily project in Bellevue, Washington." But they just didn't have an opportunity to get to know any developers or even get a chance to look at a deal. So that's what we were basically, making possible for the first time, like I said, since 1933.
And then on the flip side, in terms of sourcing the deals, how has that piece evolved in terms of, the people that are looking to sell properties becoming more comfortable marketing through a platform like CrowdStreet? Yeah,
that's a great question. And it really tracks back to kind of the history of the growth of CrowdStreet, because when we went live, and in the early years, call it anywhere from 2014 up until around 2018, we had to completely acknowledge that the environment that we were in and would operate in was what we would probably describe as adverse selection. It was a new environment. It was a new form of capitalization. And we had to know that we were going to potentially be preyed upon by groups that would come in and use us as kind of a one and done, maybe a way to, grab some money for a less than desirable deal. So what we had to do for all of those years was we said we ultimately had strong conviction that the opportunity was robust, that this could become a major part of capital markets in the future, but we had to cross the chasm, so to speak. So what that translated and made my job, challenging for those years, was to say we need to grow, but we have to do so prudently. And so we really had to, what I would describe as beg, borrow, and steal our way into good deals, groups that essentially didn't need us, but were interested and intrigued and were willing to literally help us along our way to get to good deals and good deal flow, and to say, "Hey, we'll give you this deal. You're not going to raise a lot of money in 2015. We get it. But we think you're going to be very real in 2020, for example. And we would like the opportunity to have real opportunity to raise real money for you in the future. So let's go do this deal today." So that's kind of how we had to pick and choose our way and run that gauntlet. And luckily, by around the time we hit 2018, we started to migrate more into the direction of positive selection. And now today, I'd say that, given the funding velocity, the number of investors, and the types of sponsors that we can work with on the marketplace, now we're solidly in the positive selection camp, knowing that the groups that we work with have now seen the promise and kind of delivered in terms of what a dynamic marketplace of tens of thousands of accredited investors across the country can do for them on a deal by deal basis.
So now pivoting to this report, I guess it was good to kind of hear all of that stuff and how you've kind of built this market share, because I imagine that then helps feed into the methodology of this report itself. Because I know you're some of the stuff that you base it on is third party information, like stuff from Green Street and CoStar, but then other parts of this analysis are based on the stuff that you have been able to analyze through having this deal flow, correct? So
correct.
Is that kind of like, so I guess just talk a second about how this report's put together, and then what some maybe the headline takeaways are for investors right now.
Sure. So the backdrop for the best places to invest actually began in 2020. We published our first report in 2021. But I would say the catalyst event was the pandemic itself. So we went into 2020 knowing that previous cycle was getting somewhat long in the tooth. We were getting a little bit more defensive in terms of the type of deal flow that we were seeking to bring to the marketplace. And then, of course, the pandemic drops and, the world ends for, a month or two in, March and April. We got very strategic and prescriptive at that time in terms of the types of deals that we would want to do and where we would want to do them and with what types of operators and developers we would bring to the marketplace. So what that led to was conversations with investors and essentially a call to us to say, CrowdStreet, we see you doing a few deals. So you're not doing it. You haven't completely shut down the marketplace. How are you viewing this world and what do you have conviction in? And conviction was really the operative term. We used to use this mantra in 2020 that carried us through the year to say, like, why this deal right now? Because you didn't actually have to do a deal in April of 20, but we knew that there would be some amazing opportunities if you could uncover the right situations. So that sparked a conversation internally to say, hey, look, these thousands of investors on the marketplace, they are looking to us to provide thought leadership on the where and the why and the how. It's time to actually make this an annual thing. So that then translated into our team, the internal team, capital markets and investments teams at CrowdStreet, getting together for a few months, at the end of the year, really thinking through geography and thinking about drivers, macro, micro drivers, and then producing the report. So to your point, David, we utilize third-party data, Green Street, CoStar. We're all members of ULI at the on the investment side at the executive level. So I'm a member of a product council. So we use the emerging trends in real estate. We're also subscribers to the Linneman letter. I'm a fan of Peter Linneman, so we pay attention to what he says. And then also we overlay that with our own experience, both in the existing portfolio. We've got over 580 deals in the portfolio. We've brought, I think at this point, over 600 deals to the marketplace. So there's a lot of data points across the country that can give us really, impactful insights into what's happening, dynamically right now across all of those 44 states that we've been in and across asset classes. And then also to keep in mind that while we've done 600 deals, we've looked at, thousands more. And so we can go back and kind of draw on some of those lessons learned. So you roll that on, and then you get into now Zoom rooms for, weeks on end and hash out what we're seeing and think about population growth and job growth and rental rates and migration patterns. That's been a big thing in the last year. Certain markets tend to stand out. When we published this year's report, we were able to bring 16 markets from the 21 report carry forward. And then we also saw 4 new markets come in to 22, that we thought were, better poised kind of coming out of the pandemic to accelerate with some growth this year. So that's kind of the backdrop and how we got to producing this report and where we stand now.
Just taking a quick glance at these 20 markets, what jumps out to me is it seems like pretty strong, a lot of Sun Belts, some strong West Coast, some markets that are kind of known for life sciences and tech. That seems to characterize some of what I see, just like from the city names that are popping out to me.
Yeah. So you've pretty much mostly hit the nail on the head on these markets. So I'd say dating back to 2018. CrowdStreet started to develop an investment thesis during that year. And we landed on growing secondary markets as kind of like where we felt the most opportunity was. Now, not to say that we didn't think there was going to be good deals in a primary market. And we've done, a bunch of deals in primary markets. But that primary markets would be maybe a little bit more nuanced. It would be, pockets within a primary market. For example, in the Bay Area, we would do deals in Oakland rather than, down on Market Street in San Francisco and the like. But generally speaking, we are a macro-driven kind of thesis marketplace. When we think about the areas when we see, if we want to layer in population growth and job growth with affordability and so forth. The markets that had always stood out to us, even back in 2018, were the markets like Austin, Raleigh, Durham, and Nashville, Denver, those types of markets. Atlanta, a big secondary market, I'd say almost becoming a primary market. But we were just seeing underlying fundamental demand for these types of markets, consistent appreciation across multiple asset classes, absorption, absolutely, rent growth. And so they just stood out to us as kind of where we felt like the best opportunity was. And to your point, coming out into 2022, we still love those secondary markets. I mean, now it's obviously it's no surprise that everybody loves Austin, Raleigh, Durham, and Nashville. They're everywhere. Mm-hmm. Right. What we saw is maybe a really burgeoning opportunity coming out of 2021, now accelerating 22, would be a market like Orlando. So it jumped up to our number 4, tremendous rent growth. We'd been fans of Orlando. Another couple markets that were new for this year, Charleston. I've been a big fan of Charleston for years. I actually wrote an article back in 2017, I believe, that I talked about like the next 18-hour cities. And Charleston was one of those markets that hit, my criteria for that. But in addition, with a big, year and major momentum in the life sciences market, we had to include San Diego into this year's rankings because not only is it a great life sciences market, it's a great industrial market, and it's actually becoming, it's one of the bounce back and growing, multifamily markets. We're also very bullish on Fort Lauderdale now. We've seen that market really thrive in being, the next 2 market from Miami. We've all seen that just tremendous growth in the pricing in Miami, rent growth being as high as 30% in some markets. And so you're seeing Fort Lauderdale really benefit from that, and now attracting, office tenants maybe coming out of New York. So yeah, when you roll it all up, this is, these 20 markets for 2022, we just think are really well poised to kind of come out of the post-pandemic market, continue to see, either continued momentum in kind of the Austin, Raleigh, Nashville scenario, or really bounce back and do really well in terms of like maybe Orlando and Seattle and Charleston.
And in terms of the property type, how does that factor into? So this is just kind of like identifying markets. Is it all property types in all markets, or is it some specific property types in certain markets? How does that kind of cross layer into the analysis?
Yep. That's a great question. And so at CrowdStreet, how we balance the where versus the what, the best places to invest is really going to be about the where. The what is going to be what we call our investment thesis. We publish that on our website. I'm actually getting ready to publish our 22 thesis. We're putting the finishing touches on it now. So probably by the time this podcast is live, it should be on our website. Historically speaking, we're about a 40% multifamily marketplace. Mm-hmm. Then when you look at the other 60%, your next largest asset classes, historically speaking, are going to be office and hospitality. Those are going to be probably in the mid-teens. Then we're going to drop down into kind of like the low teens, maybe 10-ish%. Then you would see things like industrial retail is going to be probably a high single digit, percentage of the total. And then from there, we've definitely been a big fan of niche asset classes. You've seen us, if you've been on the marketplace, you would have seen us do a number of self-storage deals. Mm-hmm. We have done some life science deals. We're also a big fan of, other kind of burgeoning asset classes. We are believers in cannabis real estate where it's coming around the country. So when you roll it all up, there's basically every food group is represented on the marketplace except for land deals. That's pretty much the only thing we don't do. But we're anchored in multifamily, both acquisition and development.
Do you count build to rent as part of multifamily or next to multifamily?
Yeah, good question. So I would say that for build to rent, huge fans of the space. We would consider that an offshoot of multifamily. Mm-hmm. I guess you could say it's a niche asset class, but it's really at this point probably just starting to get baked into the greater multifamily discussion. We got to be fans of that space in 2019. There's a group that we work with out of Dallas who actually started pursuing developments of that in early 2019. They came to us, they started educating us on the space. I kind of thought it became to me, it was like my favorite thing that I'd seen. Love the demographic drivers in that space, right? You've got that millennial kind of now aging into their 30s, looking for more space. They probably have a dog now. They may have a partner. They're looking for a backyard and a place to go in and out of their own door and maybe a little garage rather than, ride an elevator down a corridor and have a balcony. So that made a lot of sense to us. Also, concurrently, the other kind of barbell of that demographic being the empty nester, now maybe selling their home, wanting to maybe live in one place most of the year, but maybe migrate a little bit. And so having this kind of easy lock and leave, what's going to feel kind of like a bungalow rental to them. It's affordable, yet it still gives them flexibility on maybe spending some time with their kids in another part of the country. I felt in 2019, we got kind of all in on the space. We did a number of deals. Some of those have actually already gone full circle, far better than we would have expected at the time. But we think that the BTR space has got legs for, multiple years to come.
Yeah, I think I forget, there was a recent, maybe it was the Journal or maybe even it was just a broader industry report that they were quoting, but something like 1 out of every 5 home sales last year was from institutions, that were renting it out. And I'm surprised. I mean, I know, it's been a building business for a long time, but I still was a little surprised that the number was that high.
Yeah, it was. And I'm equally surprised. I mean, we've all seen the institutionalization of the sector that really started back in the Starwood and early days of Invitation Homes, right out there buying them up post, GFC.
Right.
But it doesn't stop, and it continues to become more of an institutionally owned space. And I mean, I won't be surprised now if you tell me that 1 in 4 homes, becomes owned at a larger corporate level. It just seems that that's where we're going a little bit more as a nation. We're seeing obviously a little bit of downtake in terms of percentage of home ownership. Still think that there needs to be single family dwellings built around the country. I think we're relatively still undersupplied. Mm-hmm. Supply will catch up probably later this decade, but still a fascinating space. And I think overall a good, long-term store of value for investment.
One other question. So like industrial was a little lower on your list. I think given that overall it's been one of the strongest sectors, but I think that you've done a little less of that than multifamily. And I was curious about that, like how it ended up a little lower in the tier. Is it just given the kind of investment sizes and the competition in that space that makes it a little bit less on volume for your platform?
Sure. That, kind of the competitiveness is one aspect of it. I would also say that the other aspect, which is limited supply on the marketplace a bit, so to speak, would be that I'd say today we view the best opportunities in industrial really probably mostly on the development side. Mm-hmm. We're a stabilized yield on cost driven type of platform, right? At the end of the day, I think because we are multidisciplinary, we're looking at what does it take to either acquire and stabilize this asset or build this asset and stabilize it? And what's the yield on cost? What's the relative risk to get there? And what's our corresponding cap rated exit, right? And we're looking for spread at the end of the day, no matter what it is. And that helps us think about, hotels versus industrial versus multifamily. And so in today's market, acquiring industrial, I think it's tough when you have to pay a 3 cap on in place to buy an industrial project. It makes that, acquisition very difficult to underwrite and get above, a levered return on an IRR basis in the double digits.
Right.
And typically speaking, returns, targeted returns on the marketplace really begin at about 10 IRR levered on a roughly 5-year hold or a little bit longer, and they go up from there. So it makes that challenging for us to find, acquisitions that pencil, which really then positions us to go out and find developments, because that spread between stabilized yield on cost and exit cap today is greater than where we've seen it in the past. I would say that in the last part of the cycle, call it 2019, we were seeing deals that we thought could pencil to 125 basis points to maybe up to 150 basis points of compression. Now we're seeing that over 200 basis points. And so we're going to go run after those types of deals where we really think that we can stabilize at a high 5 and really sell it at a high 3, even though we're going to probably underwrite in all reality a low to mid 4 cap, just so that we can have a little bit more sanity in the underwriting and allow for some cap rate expansion in case it occurs. But we'll take that opportunity where we can find it. So because it's a little bit polarized in our perspective is what is going to make industrial just a lower percentage of overall volume, because it has less transaction volume. I mean, you can look at the RCA transaction data from last year. I think off the top of my head, I thought that if I recall, I think multifamily was about $335 billion last year, while industrial was about $166 billion. So it's already half. And then you're kind of slicing into the part of the half, which is just going to make it a lower overall quantity on the marketplace.
Just one more question. So we're talking about retail accredited investors who are looking for exposure. What are some of just the general tips or misconceptions or questions that kind of investor brings to the table? Like when someone's coming to you that they've never invested in commercial real estate, they're interested in the space. Are there common things that you feel like you have to answer a lot to get people comfortable to be getting into this kind of investment?
Sure. That's a great question. I think that there's a lot of myths, I think, on both sides of the marketplace. On the investor side, I think one of the reasons, there's a lot of nomenclature and there's a lot of, specific numbers and metrics that you have to understand to start to feel comfortable investing in commercial real estate, right? I mean, we can talk about cap rates and yield on cost on this podcast, but for people that have never invested in real estate before, they can get hit with a lot of unknown information and literature. So I think the first thing is overall is education, which is why we spend a lot of time educating the investors on the marketplace. I think another thing also for investors to come in and understand is really that they are stepping into a private equity investment. There is such a thing, I think, as the liquidity premium, right? These are illiquid assets. So hence why the returns are higher than you would otherwise think in a publicly traded REIT or something that has daily liquidity. So I think there's a little bit of that education that needs to filter through that, hey, yes, we can go target a 20 plus IRR, which would be like a 1.7 multiple on a 3-year, build and sell type project. But there's a lot of assumptions that go into that equation, and those variables can change. We can delay construction. We can lease up at lower rents than we thought. We can have a different type of market when we go to sell. So I think those are the key things that for investors who are totally new to the space to begin understanding is that just because we put a 20% targeted IRR on a page, that doesn't mean that that's what it's going to be. It can be lower, it can be higher, anywhere in between, and that you really are buying into the sponsor first and foremost. I think that's what we kind of talk about on the marketplace, that you're really picking jockeys, right? Then picking horses. And then from there, you can go on to pick, strategy and so forth, but that you are signing up for what is an illiquid asset. And if you can handle that illiquidity, then on average, you get rewarded over time. So I think that's kind of the big thing on the investor side. On the sponsor side, I think it's the understanding a sponsor might come onto the marketplace and underestimate the overall sophistication of the investors on the marketplace. And it's totally fair to say that investors on the marketplace might not be the most sophisticated real estate investors, but they're sophisticated individuals. Absolutely. You don't get to be an accredited investor by being unsophisticated, right? So they're decision makers at their business level. They are chief of cardiology at a hospital. They're lead partners in major law firms and things like that. So we spend a little bit of time educating sponsors on really who is investing with you. And at the end of the day, if you're transparent and you report back to them and you treat them with respect, then that's the path to success. And the news can be anywhere from great to not so great, but provided that you're honest and straightforward, that's how you build trust. And I think that's an interesting place to end this topic on, because at the end of the day, I think what the CrowdStreet marketplace really is, it's a trust platform. I mean, we can say we're doing deals, but it all anchors on trust. And if there's not trust from a sponsor to an investor, then nothing really happens. So I think that's the key thing on both sides to end with, is that you are looking and seeking to build online trust, and the marketplace is just there to facilitate it.
Well, I think that's a good note to end on. I thank you for rolling with my sometimes jumping around a bit from question to question, but I appreciate you coming on and answering everything I had to ask you.
Oh, absolutely, David. It was my pleasure. Anytime.
Gentlemen, this has been fantastic. I love the fact that you ended on that note because trust is key in any type of relationship, and investments are a relationship. So, gentlemen, thank you so much for your time. David, of course, thank you for facilitating this and bringing him on as a guest. I learned a ton, and I think the audience did too. And audience, we trust that you learned a lot in this as well. We thank you for tuning in and listening to the Common Area Podcast with David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your colleagues. Again, thank you so much for listening today. For everyone at WMRE, this is Eric Johnson inviting you back in 2 weeks for all the stories that matter to you. And we'll talk to you soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of WMRE or Informa. The content has been made available for informational and educational purposes only.